Let's get straight into, first of all, a look at the economic scenario, because this having a major impact on the kind of activity we're seeing on the currency front right now. Let's cast our glance to some of the macro themes that have emerged that have certainly got your attention over the past couple of weeks.
Well, Alishia, with the data we're getting at the moment, it marks the end of the third quarter. So once we have this week's retail sales out, for instance, we'll have a much better idea of how third quarter GDP actually shaped up. And of course, with an MPC meeting coming up shortly too, there really does seem to be a lot of interest, particularly on domestic economic developments. So certainly we'll be keeping our eye out for retail sales this week. We're anticipating that there's probably going to have been a little bit of a pullback. It was 6.4% year on year in August, and now we're anticipating the September number to have been slightly lower at about 4.9%, and I think that's roughly in line with the consensus estimates as well. And last week we had the mining and manufacturing numbers, quite disappointing, as had largely been anticipated, impacted heavily by strike activity in the mining sector that is still ongoing. So certainly as far as the third quarter is concerned, a lot will be riding on the retail sales numbers, because the retail and trade sector makes up such an important component of GDP. Yeah. And we already know that the mining sector looks quite weak. We're expecting it to subtract from growth, and manufacturing shouldn't deliver a stellar performance either. So all in all, we're expecting quite a weak quarter three. We've penciled in growth of sub 2% quarter on quarter on an annualized basis.
So let's bring it then to the kind of impact you see it having on the local unit specifically, especially in a context where we've got lots of concerns about the health of the global economy as well, and that's certainly putting pressure on the euro, for example. We had the euro hitting a 2-month low against the dollar on Friday's session, and yes, some strength filtering through this morning, but the pressure and the heat still on.
Yes, absolutely, and certainly against a backdrop of weak global growth, we actually maintain our view that we're going to see the euro-dollar head towards 115 over the next 6 months, and really between the euro and the dollar does seem to be a race to the bottom, with both economies, both regions still struggling from an economic perspective. So certainly we expect to see some weakness come through in that currency pair, and that's likely to also be reflected in the rand. As I mentioned, our domestic economic prospects aren't all that promising. So it certainly does seem that there could be further weakness on the cards as far as the rand's concerned. We have a year-end fix of 875, but there's nothing to indicate that it couldn't weaken beyond that target before strengthening slightly towards the end of the year, as it tends to do, just mainly based on seasonal trends.
Just how much impact do you see carry trade appeal having at this stage of the game with all that's playing out, Nomvuyo? Because we know that that has been a support factor in the past, with our interest rates sitting where they are relative to the rest of the world, and obviously with MPC meeting coming up pretty soon.
Yeah, I certainly think that as far as carry appeal goes, as far as the rand is concerned, that is definitely seems to be on the way. And at the moment, we're anticipating another cut in the repo rate, and it does seem that expectations around the possibility that the Reserve Bank could cut again also seem to be rising. We had the IMF also coming out to say that they see room for South African policymakers to cut rates again. So certainly if we do have GDP growth in line with our expectations, i.e. below 2% for the third quarter, and with everything that we know about strike activity and poor production, and how that could potentially impact growth in the fourth quarter, could be even lower. So certainly in our case, in our opinion, the case for a rate cut remains quite strong, and therefore is likely to reduce carry appeal, as far as the rand is concerned.
Taking a look at euro-dollar, run us through what you're expecting to be some of the defining features moving forward for that currency pair specifically, because now that the US elections have come and gone, things seem to have quietened down quite a bit.
Yes, certainly. I mean, I do think that the defining characteristic of that particular currency pair is going to be, as I said, that race to the bottom, with both of those regions mired in all sorts of trouble. I do think that there's probably going to be more of a focus on the US, of course, coming up. Even though we have the elections behind us, the attention has now shifted to this looming fiscal cliff, and that certainly is going to impact on the dollar, probably weigh quite heavily on the dollar going forward, because in our view, the likelihood of an easy or tidy outcome seems seems to be, you know, with Republicans in charge of one house and Democrats in charge of the other, seems that there's likely to be further bruising politics ahead for the US. So we can't rule out the possibility of another potential ratings downgrade for there if they don't get the fiscal cliff sorted out. If they don't, of course, that could further impact on the US's growth prospects and also further dent consumer and business confidence at a time when the economy really needs those confidence levels to improve and so ensure a sustained recovery. So probably the dollar will emerge the worst of the two over the coming months, but certainly we're still targeting a 115 over the next 6 months.
Well, let's leave it there. Nomvuyo, thanks so much for having joined us this